we have a fairly tight kind of schedule. We don't have too many sections, but our hope is that this first workshop, hopefully in a series of workshops that we want to conduct on insurance inclusion, is going to take care of I think take care of even getting into a deeper discussion on specific issues and which otherwise are discussed as part of a broad brush host of other issues that we think about when it comes to low income households or risks which are pertinent to typically small ticket kind of approaches to underwriting. So what we are hoping to, what at least for Dwara Research, what we are hoping to achieve is really to, I think, shed focus on select issues, and that's why the theme of the workshop itself within insurance inclusion. And this comes in the back of, I think, an extensive piece of work that we had undertaken last year, and which came out in the form, and which completed, and which came out in the form of a report early in January of this year. From that, I have actually just, we've taken insurance. Although that report really looked at challenges for what we describe as, non-credit products. That's really we're talking of insurance, investment, pensions inclusion, and that's really non-credit because typically, I think if you look at traditionally in the past, India has really forged ahead in terms of payments and credit. But the picture is rather bleak when it comes to these other three categories of products, and for various good reasons. Now, this is really our first attempt. So that report really articulated a lot of the challenges from the supply side. And we also looked at issues with infrastructure as well as issues with kind of regulatory language, etc., which are stymieing or preventing outcomes for low-income households when it comes to insurance inclusion. So what and from there on, it goes into specific aspects. So what I'm hoping to achieve for today is to focus on, let me say, three specific aspects that came out as being pivotal to getting it right, insurance inclusion, getting it right for low-income households. One is what I would describe as contract design, and pricing is actually a subset of that. And the other are in relation to incentives design, as well as what we call life cycle servicing, right? Because insurance is not just about selling the product, but it's also about servicing the customer and seeing through the promise or the commitment till the end of the insured period, right? So there are so our objective is really to kind of deep dive rather than cover a lot of other issues. So how I will do this is, I'll spend about 20-25 minutes just talking about some findings from the report. And I would, love for all of you to take a closer look. I'm guessing some of you might already have taken a look. And so apologies if some of the messages seem to be repeated. But please, and following that, we will have Prashansa's presentation. I'll introduce her just prior to that. So that's really that'll give a good segue to the panel that we have lined up for today, which will focus on just practitioner perspectives from incentive design as well as life cycle servicing. So let me just jump into my my slide deck, and please give me a second. Also, just to kind of this is things that we have, it's clear, but please make sure that wherever you feel like there are questions that you have or clarifications that you want to ask, you can use either the Q&A or the chat facility that is there in Zoom. By now we're all, I think, fairly familiar with these things. So what I will do is, so there is no option to raise hands for the attendees, but if you do that, if you just kind of type in your questions, I'll make sure that they are reaching either me or Prashansa, and then we'll take it from there for the panel too. Kamesh, please let me know if the slide is visible, the deck.
Yes, Deepti, yes.
Thank you. All right. So I think so. We have to always, at least in Dwara Research, we always make it a point to step back and say what is the expectation from a robust financial system for individuals, households, and enterprises, and vis-a-vis that, where do we stand, right? So just a quick kind of check. When we talk of financial products, we're really talking of I think 4 or 5 functions. So there's and these products are really what we call credit, insurance, investment, and retirement. And there are specific functions that each of these are expected to undertake and work well for the household or the individual. Particular to insurance, we know that insurance is meant to cover and protect from a financial shock or a financial burden that comes in the wake of an unprecedented shock. Some of the shock may be expected, some of it isn't. But the objective is really to be providing a financial cover, right? And the ability of insurers is really to know what is the predictive, or how well can you predict both the kind of the probability of that event happening and the loss that can be kind of reasonably expected as a result of that event, right? Like, so if you do both those well, then they can do insurance well. Layered over all of this is really an ability to do payments very well, and we are talking of payments both digital as well as non-digital. However, payments through a place that is safe and easily accessible, right? A place that you can keep store money and from which you can transact easily. So with that, but we know that in low-income households, their characteristics are markedly different from what we would otherwise describe as mass market or middle income. So if we were to use a kind of financial statements lens to it, then we know that there is a lot of volatility in kind of income streams. Volatility, and a lot of that volatility is expected, so it's seasonal, and many a times it isn't. A lot of it is unforeseeable, and whereas a lot of the outflows, which are really expenses, many a times are again expected. There is a large chunk of it which is known to the household upfront. And so irrespective of what happens on the assets, on the inflow side, there is an expectation that households will have to manage the expenses that are expected to come about. There is a lot of, at least particularly in relation to Indian households, we know that assets, if you look at the assets, there is a majority of it is physical assets. They are illiquid. Financial assets form only a sliver, less than 10%, around maybe 5 to 7% are financial assets. And there is a good, I wouldn't say there's a good mix of financial assets. A lot of it is really exposure to things like bank accounts, FDs, provident funds, and also endowment plans. And then we have products like, NSC, savings certificates, all of that. Now, given that, and then of course, there's a lot of reliance on loans, right, which what you describe as liabilities on the balance sheet of the household, in order to tide over all of these fluctuations and volatilities that we've been talking about. And of course, the loans come with a cost associated with it. And keeping this in mind, we have to think of current products. They are spread between all of these products that have been kind of placed on the right side of the slide. I won't talk too much about the study, but suffice to say, let me just give you broadly what we found. When we looked at the life cycle experience of low-income households when it comes to these products, insurance included, we've looked at it from various dimensions. So here there are 6 dimensions. One is ease of access at a location nearby. It's not as same as accessing a payments transaction nearby, right? Like it's not, we're not talking of a BC touch point when we want to sell these products. It has to be a bit more sophisticated than that. Ease of onboarding through KYC, whether I can use the existing KYC or not. And the nature of KYC that I need to bring, protection from mis-selling or ease of access to reliable financial advice, ease of repeat transactions, which in fact is very key to low-income households being able to have continuous protection, right? Ease of life cycle servicing. So we are particularly in the insurance space, we are talking of claims, and ability to do that easily and effectively with support. Ease of accessing multiple products, and this is really it. And we had the study had looked at different, mono product providers, multi-product providers, and digital only fintech channels. Mono products are typically what we would describe as mono product distributors, so insurance distributors. um, brokers or corporate agents. But multi-product providers here are chiefly banks and NBFCs, where the whole set of, so there are permissions to do all of this, right, under what's called third-party products, which RBI permits banks to undertake, and also NBFCs. So we don't need to go into the specifics of how bad the insurance story is in India. I think we don't have very great metrics, but the most commonly used is really insurance penetration, which is really premium to GDP, and insurance density, which is premium to population. On both counts, India fares rather badly. And there are other estimates that look at what is the nature of coverage. So just to give you a data point, you know, on average, a working person is assured of only 8% of what may be required to protect a family after the death of an earning member. And that is against, 44%, 60% across, I think, Australia, Taiwan. So some of those. So these are, I think, stark, data points to say how bad the situation is. So let's go to the supply side, right? What's happening there? So in the past, we've seen that typically we've seen branch-based approaches, branches mostly dominated by banks. Then we've had the community model, which is really, I think, driven by LIC. We're talking of a time when this is before even IRDA itself got set up in 1999, where we needed some kind of a community level, individual to be able to ensure distribution well. And we know that the LIC agent has become as ubiquitous as a postman in terms of familiarity, right? If even today, if you look at large banks, we don't have any examples of large banks who have done a BC operation so well that they can serve a full suite of products for low-income customers. Mostly it's been just DBT delivery, right? And small ticket transactions on bank accounts. The new SFBs hold a lot of promise, but we looked at sort of commission income as a percentage of total income ratios, and we don't see much of a difference or any kind of big story to say there. So they seem very similar to how more established scheduled commercial banks have been operating on this side. Unfortunately, when we talk of low-income households, really credit life is what comes to mind. And credit life is not life insurance, right? So actually, let me just kind of caveat here that our study really looked at life insurance and some of the non-life products like personal accident, a little bit around health insurance, but we haven't got, I would say that predominantly we have looked at life insurance. We also haven't, while we haven't made any specific comments on government-led insurance, because I think there the story is it's a little more different, and we needed to do a little more research before we could conclude whether or what has been the impact of government-run schemes or government-subsidized schemes in insurance in terms of vis-a-vis the ability of private kind of providers to deliver. So I'm just coming to the specifics. So like I said, we'll talk about just distribution channel and incentive design, and we'll talk about suitability, right? And so just jumping in straight, there are about 14 types of distribution licenses / registrations that IRDA requires on the insurance side. We've broadly clubbed them into 4 categories. What we would describe as the agent model, insurance agent model, then you have an insurance broking model, and then there's a marketplace distribution model and others. So, what the chief difference between an agent and a broker is really that the agent is a representative of the insurer, whereas the broker is a representative of the customer, right? And in the broker regulations, brokers aren't allowed to engage in any other business. And whereas the agent, being a representative of one insurer or a couple of insurers, there are limits to how many you can be an agent of. That's how IRDA has kind of envisaged how these registrations will look like. You can't do more than that. So it's very kind of clear to customers that here is an agent, and the agent represents the insurer. So while there are, historical reasons why there were these limits on the number of products by each agent, typically what at least our understanding is that it was meant to, prevent agents from switch. It was meant to make sure that agents stick to their insurer, and they don't, they're able to make a choice, make a kind of informed decision between the set of products that they have to the customer, right? And that you are not kind of overburdened with choice. But unfortunately, what we see on the ground is that agents, have switched between insurers, and this has not particularly reduced any conflict of interest during sale. The broking model, again, you can't engage in other businesses, but however, the insurance marketing firm or the IMF allows you to, engage in other non-financial businesses as part of your business model. So it's not. So we see that there are between these various categories, there are different kind of overlaps, and therefore these functional differences are blurred and they are fairly superficial. The monoproduct distributor, I think, would find it the most difficult from a kind of cost of customer acquisition and kind of repeat transactions to be truly viable in, say, remote regions. And so, anyway, so I think just on the, so that's really on the distribution side. On the incentive design, we know that while the regulator has created these categories of distributors, they club everything together under what's called insurance intermediaries, except for the individual agent, and have kind of applied fairly uniform volume-based incentive structures. Now, what this has done is this has resulted in, and there are also features of these volume-based design incentive design structures, which are, I think, particular to insurance. Typically, when you think of multi-year products, we have a situation where there is a high upfront commission and there are low trail commissions. This has resulted in a lot of lapsation and persistency issues, which a lot of us are familiar with. Is this so? I think a lot of the debate is around, has this actually is it because of the commission structure that we have ended up with such low persistency ratios, or is it really the only way in which we could service retail customers, right? Like, so that's the big question at hand. In the case of non-life insurance products, we don't have this much of this much kind of an extreme case of let's say outcomes really when it comes to selling to households, but nevertheless their coverage is even less in terms of the story that is available to say. In terms of micro insurance, again, we've all known micro insurance as a subcategory. There are kind of limits on, I think, the manner in which it has been envisaged, both from an incentives as well as kind of products that you can sell. They are slightly, they're typically a subset of the full permissions that are available to other insurance intermediaries. We have the situation where if you're not selling micro, you could, if you're just a distributor, you could sell a normal insurance product when a micro insurance product may seem more suitable, simply because the incentives lead you to do so. And so I have to talk a little bit about investments, simply because we know that insurers in India, and of course in other parts of the world too, but IRDA really regulates not just pure term insurance, but also insurance products where you have some form of an investment embedded, right? And so it's important that when we think of low-income households, we are really thinking of a low-income household to whom this full set of products on the investment side need to be sold. So everything under IRDA, but also, mutual funds under SEBI, stock, even stock picking, which again comes under SEBI because this is a securities regulator. And we have, say, FDs, etc., which come under the RBI, right? So it's in that space that we have to kind of place endowment plans and ULIPs and similar such products when it comes to selling to low-income households. So just to kind of, summarize, we have distribution channel regulations which are split across various regulators. Products need to be synthesized at the household level. However, we know that low-income households will have to go to multiple distributors in order to obtain a suite of financial products, particularly in rural India. And they are not able to access good advice, right, easily, that they can rely on. Sorry, let me just check. We have a couple of questions. Yeah. Yes, Pranav, I would agree. So let me come back to that question in a bit. So that's around the distribution channel. Now, if we go to, so we have like this kind of grand idea that we have, which is what we think needs to be done. And this is not just in relation to insurance, and I would call this as the financial services intermediary license. I think it's a good solution to fix this kind of patchwork of regulations that are there around distribution channel, to say, can we imagine one intermediary who can sell all of these products under various regulators, such that Now it is possible to synthesize these products at the household level. You don't have to be a bank in order to do this, right? You can just be a non-bank distributor. However, we have certain protections in place, such as showing adequate capital. And it's not like a capital adequacy requirement that's applicable on banks or NBFCs, but really to say, here is my initial capital, because of which I know from a tech backend perspective, I'm able to do this job well. All transactions, again, using a digital interface, you need it to be originated from the customer. KYC needs to be reused, because you don't want to reuse KYC simply because each regulator is asking for a new KYC when it comes to a new product. Even for products which are under the same regulator, you still need to do a new KYC, right? So is there a way to reuse that? So we have a couple of recommendations there, but I won't go into that here. But really, and then bringing on a suitability lens to the process of sale itself, and also servicing. And okay, so and then on specifically on the incentives bit, I think we've done a little bit of thinking, but I would love to I think get more broader inputs. We've seen what the problem with incentive design is, and there's a lot of detail in the report that goes into that, right? We are talking of high upfront commissions which then suddenly trail off. And so you have a lot of churning and lapsation happening after the first year, because the person who receives the commission isn't incentivized to continue engaging with the customer. And they end up receiving commission whether or not they have really been in touch with the customer or not. Or have been involved in the ability of the customer to make a repeated kind of a multi-year premium, right? So if we were to flip that problem and then say, okay, fine, if we actually end up, or rather we took a step to imagine a situation where we could flip that problem, right? So we are talking of, can we consider a situation where we have incentives which are proportionate to the cost and the effort, right? We have to move away from a high upfront commission. Not to say we have to completely remove it, although that's the direction in which SEBI has gone when it comes to mutual fund distribution. We have to incentivize repeat contact and transactions, and we have to incentivize good experience when it comes to life cycle servicing, which is really good claims or payouts experience. And we have to have a way to track behavior of distributors, which I know IRDA started doing that in a fairly broad sense. So can we imagine a situation where we have large or more well-established distributors facing a progressive reduction in commissions due to their economies of scale? And when we think of an upfront commission, can we put a cap on it, right? And this cap is again something that SEBI has experimented with. So while the percentage still remains, we could still place a cap to say this can't go beyond that, because the objective of the upfront commission, or rather I wouldn't say objective, we understand that the need for a high upfront commission is to cover for costs that or enrollment costs that the agent itself, himself or herself, had undertaken right upfront, and we wanted to compensate that. So this is one way to consider. If you put a cap on that, then why not? Right, and to ensure that the upfront commission is not going to be greater than 1.2 to 1.3 times of a trail or subsequent year commission. And in an extreme, if we can really push the envelope on imagination, we could even consider gradually increasing commissions over subsequent years. But I suppose, yeah. So I think for now, so that's really on incentives and design. So let me spend just a minute more on suitability, on product design. We know that when it comes to suitability of products in the insurance space, it's really to ensure that products are appropriate and adequate, right, for the customer's needs and interests, and their ability to pay premiums, particularly on the insurance side. On the investment side, for suitability, we'll have to imagine a situation where we move beyond what's called risk appetite to what's called risk capacity based assessment, right, to ensure that the transaction meets the customer's objectives while you're being cognizant of our ability to absorb the new risks which arise from having engaged in this kind of an investment. But in reality, we know that there are multiple regulatory approaches to suitability, and many a times it uses a very product-specific approach to suitability. It kind of doesn't look at everything else outside of it. And incentives certainly do tend to distort behavior when it comes to the sale of suitable products. And some of the regulators have IRDA interestingly has not, which is very interesting. But the other regulators, at least SEBI and PFRD, have gone in the direction of separating advice from sale through a licensing. So you have we have what's called an investment advisor and a retirement advisor. Even there are some issues, but I won't get into that. Interestingly, what we found was, and I'm sure many of you would be aware of it, which is that in 2013, IRDA had put out a circular requiring a determination of suitability as part of the standard proposal form for life insurance. This was not mandatory. It was a good thing to have, and this was, unfortunately, and it had really good language, right? It even required insurers, life insurers, to collect data on the liabilities picture, right, to assess whether this particular product. And imagine we are talking of multi-year, typically where there is an investment embedded in the insurance product, right? Where you have to kind of look at the liabilities picture. When I say liabilities, is really the loans and kind of other credit exposure that the or requirements or liabilities that the household has. And however, this 2013 circular was deferred in 2014, and then it was later on repealed in 2018. So that wasn't in force, and it never came in for various reasons. In 2019, a suitability determination circular again came out, and here the language was a lot more refined. They included what's called a board-approved policy for how you engage in suitable sale. And this was made mandatory on not just life insurance, but also on the agents and intermediaries, right? And there was, however, what we found was there was a dilution of language from the 2013 circular when it comes to placing responsibility on insurer for doing internal supervision, internal processes and checks and balances to make sure that whatever you have as a policy is actually, happening on the ground. There was also a requirement for submitting quarterly statements of misselling complaints. Again, I have issues here around how good quality that will be. So we're not sure whether this is translated, this approach by IRDAI, which itself is great, has translated into better customer level outcomes, right? And which is why we have what we call universal kind of conduct obligations, such that we have obligations which are uniform across anybody who's trying to sell or who's trying to engage in the act of selling, say, credit or insurance or investment or retirement, to say that irrespective of who you are, when you face the household has to experience the same kind of behavior irrespective of who you are regulated by, right? So that's really, and I think here I'd just like to kind of talk about what's called globally unsuitable products. This is really this, I think there is a lot of evidence and a lot of discussion on this theme, which is that many endowment products and I think certain other products have very low IRR. And in many cases, once you adjust for inflation, it gets into the negative territory. And still these products are being sold to households, particularly low-income households. The question is why, right? And why should that be the case? Why is this continuing despite all of these efforts around suitability and determination of suitability? So there, I think there's a lot more ground to be covered. What we think is that we need what we call an articulation by the regulator of what's called globally unsuitable, to say that these products must not be sold to households or businesses below a certain, say, income threshold or a net worth threshold, or to individuals above a certain age. That's the only way to avoid these kind of products being sold, right, to particularly vulnerable households. So let me just stop there. I feel like I have kind of overshot on time, but I would urge all of you to kind of take a look at the report. What I would do is really actually just go back to continuing the session. If you certainly if you have more questions, please do feel free to kind of paste your questions. I would also, so let me just kind of stop here and go with providing an introduction to Prashansa, because that's really the kind of what we're, at least that's what the plan to get into contract design is really that. So I think this is our first kind of engagement with Prashansa. We've had multiple conversations with her, so but really happy to have her on board here for this. So Prashansa is a qualified actuary from the Institute of Actuaries of India and UK, and she has 14 plus years of experience. She's worked across actuarial and business functions with private insurance players in India, and her kind of role has spanned from, say, product pricing to shareholder reporting to being chief of staff to the CEO, the chief risk officer. Currently, she is the chief actuary with Manulife Myanmar. She has a very keen interest in financial inclusion, and her prior, before taking on this assignment, she was with the ILO Social Finance Facility in the Philippines, and there she was involved in the implementation of a holistic integrated risk management financial bundle, and that kind of straddled insurance, savings, credit solutions for the clients of a microfinance institution. So I think over to you, Prashansa. Please enlighten us with your presentation.
Thank you. Thank you so much, Deepti. I assumed you would be a tough act to follow, and I'm sure you are. So thank you so much. This is a really interesting topic, and especially for an actuary to be commenting on it. So before that, I think I'll just start with the statutory warning that I think the views today are clearly mine alone and not any organization that I'm representing. So with that, I'll just, I start with the presentation that I made. It's hopefully a short one. Would you be able to share the slides?
Sure, just a second.
Perfect.
Can you see it?
Yes, I can. Thank you so much, Kamesh.
Yeah.
So perfect. So, so before we get into answering the question of how to get the pricing right for the low income segment, it's really essential, I think, in most product development departments in an insurance company to first understand what segment we are talking about. And it is markedly different from a mass affluent segment, which most of the conventional insurers have been focusing on and probably continue to do so. The risk exposures, their current coping mechanisms, and can help to build out an insurance solution that at least helps to address some part of the problem, if not all. So in terms of structure of my presentation today, I am going to spend some time in understanding the low-income household segment, and how do we align the segment need to the contract design, and then also going over the existing market landscape for microinsurance contracts, some of the innovative solutions that are already present in the market, and the future opportunities. So I'll just start with the first slide here. Kamesh, could we go to the next slide, please?
Just a second. I'm facing
some
issue with changing.
Super. So this is really to give some context of the size of the segment, which is called the low and middle income. As you can see, it is linked to the income levels, defined as, $1.25 and up to $4. It has been defined as the low and middle income. This belongs to a research that was done almost a decade ago, and it implies this population size to be of 4 billion, and estimating the premium size to be around 40 billion. Now, so insurance products which are offered in this segment are typically known as microinsurance products. And the definition is interpreted in multiple dimensions by regulators, providers, and distributors. So I'm going along with the target group definition, which is to say that these products are meant for a specific socioeconomic group. But usually you would find regulations which define this as a product by placing premium and sum assured caps. In some entities, in some legislations, you also find certain licensed organizations who can typically sell microinsurance, and not all. And that's also true for some of the distribution channels. So moving on to the next one, where we try to understand the priority of risks for this segment that it finds itself exposed to. Could I look at the next slide, Kamesh? Thank you. So I actually take this from a report from ILO Social Finance Archive, and it's a really great assessment of it's a cross-continent assessment of risk exposures of low-income households from countries which have representations in continents of Africa, Asia, Eastern Europe, and even LATAM. And the low-income households here surveyed have been asked about the priority of risks that they find themselves exposed to. And it's really interesting how the consistency of the answers it's mostly going with the loss of a household income earner or even illness in the family. So those are two of the greatest risks being identified across geographies. And the great thing is that they can be mitigated through insurance. And this helps us to sort of start to work on a product design which would be suitable to address these risks in mind. On my next slide, yes. So I think Deepti's already touched upon this, but I think just very quickly, so there are many shocks such as illness and the death of a breadwinner, theft, and even natural disasters. So they all have a negative impact, both in terms of reducing income and also in increasing expenses. And most of the low income households are seen to actually save in kind. So they would be investment in livestock, in household goods, and cash would be kept at home or with a designated safeguard in the peer group. And the problem with that is that in times of stress, this may not fetch the value that one is anticipating it would. Also, if the stress situation is localized, then the social and the professional network is also experiencing the same stress event, and they're not going to be ready to support if you're facing the same stress event as well. And depending on the severity of the risk event, you do find low-income households deploying multiple solutions. So they could be going for modifying consumption, pawning valuables, selling productive assets, and even turning to social and professional networks for emergency funds. Again, I think just understanding these coping mechanisms just help to supplement any insurance solutions that we're trying to build to address these risk events. So my next slide is actually the last understanding of the segment here. Yeah, so now this actually, so as part of the ILO social finance program that I was a part of in the Philippines, we interviewed around 600 microfinance clients where we asked them about the current coping mechanisms and their exposure to some of the financial instruments of insurance, savings, credit, and even the government social schemes. And what were some of the features that they appreciate and what would they rather improve? And majority of these responses, they seem very obvious and some not so much. But surprisingly, a lot of these obvious features are still not being offered by majority of the financial players. So in terms of insurance, what was mentioned as they would appreciate is flexibility in premium payment, short durations, quick and direct settlement of claims, especially an appreciation of an instantaneous payment in the event of death, and probably the remaining claim amount being given to them once the due process is over, but at least giving a certain sum right away on the occurrence of the event, so that it also helps to avoid informal borrowings. In health insurance, inpatient and outpatient benefits were sought after much more than a HospiCash kind of a product. In savings, liquidity of the savings were preferred even at the cost of sacrificing higher returns. And credit products, I think it was an established need that there is a need for fund, which is not only backing enterprise reasons, but it's also to cover off consumption patterns, like on account of health, funeral, housing, education of children, and other ceremonies. So you do find a number of microfinance institutions starting to talk about emergency loans in the Philippines. Lastly, on the government social schemes in the Philippines, they're much appreciated for their expansive networks, but accessing them has been proving to be arduous, and which is why you don't find too many takers. But again, and that's the gap which is also being plugged again by microfinance institutions in the Philippines by offering structured loans which finance premiums for these schemes. Moving on to the next slide. So I think just assimilating the information from understanding the segment, I'm just moving into what does offering microinsurance really mean for these three broad players, which is regulators, insurers, and customers. So I'll first take on the insurer. So for most commercial conventional insurance, stepping into microinsurance or stepping into offering products for low and middle income segment it requires earmarking funds for innovation. It is considered an innovation. And it also requires building out capacity and overcoming internal risk thresholds to be able to test out solutions. And you would have to also start giving a thought to what sort of a system and a process would apply to a $10 policy versus a $1,000 policy or a $10,000 policy that one is used to selling. Because the same systems and processes may not be as suitable and may not be as commercially viable to be able to do that. In terms of seeing this from the lens of the customer, I think product innovation has clearly been lagging. The insurance solutions that are available for the mass affluent segment are clearly not available. Like in terms of the flexibility that one has in those kind of products is currently not available for low and middle income segment. And I think as Deepti rightly pointed out, even credit life kind of a product, it actually addresses credit risk concerns of a bank and not or any lending institution, but not so much the customers. And I think that's the lens one needs to start thinking about. Also, entry barriers. For micro insurance contracts, having exclusions, having underwriting assessments would have to be really simple. And the most important piece would be an awareness of utilization mechanism. How does one claim? Where does the claim payment get paid out? What are the networks and the engagement points being created for such stresses? And I think last one on the regulators is, so by and large, there has been a significant development across regions. A lot of regulatory bodies have created green channels, have created regulatory sandboxes to test out innovations and solutions. But there is still quite some distance to be covered. There are still impediments in terms of product approval windows. They're rather long. Ensuring an end-to-end seamless digital process becomes a bit of a farce the minute we introduce wet signatures as a mandatory requirement. Also, the use of alternate distribution channels. Just using your traditional distribution channels may not solve this problem, but you would want to probably reach out and establish partnerships with alternate channels. Also, allowing bundled product offering. Just being able to club products, being able to add non-financial solutions to it would also make the product a lot more attractive, both from a consumer standpoint and from an insurance company standpoint. So moving to the next slide. Great. So I think very simply, I'm just covering off some of the contract design features, which I think would be applicable and how would you solve for it for the low and middle income segment. So I think one thing is very clear, and that is the conventional insurance processes no longer remain applicable to this segment and require some strategization since the cost structures are different. And the contract design factors would just go beyond technical pricing of the contract. It means impacting the complete customer life cycle. So I'll start with the first one and go in the clockwise fashion. So the credibility of data and the ability to validate. Now, I'm sure this is mentioned a lot and probably from my profession of actuaries, but it is a serious drawback. There is a clear dearth of data which covers this segment off, and that leads to building out assumptions and then getting past and the premiums becoming too expensive and seeing negative IRRs, and then a product not being very viable. And that feedback loop of seeing how your claim experience emerges and then passing on better premiums then just never happens. But there are ways and means of solving for this lack of data, and that is just by getting creative. So deploying alternate data sources, learning from other industries like digital lenders who leverage SMS logs, handset details, utility bill payments, microfinance institutions that gain access to household ownership of assets. Insurance companies too, while pricing, could be using such data points. The second one is really, I think, customizing the solution and customizing it to the characteristics of the target segment. We know there is a volatility of income stream. There is a clear seasonality in the cash flows. There is limited access to financial institutions. Thus, creating solutions that are flexible on premium payment terms, on benefit terms, duration, and as well as claim payment. So if somebody doesn't have a bank account, how would we make the claim payment back? So I think just those are the things one would have to be cognizant of. And all this rests on a very supportive policy administration system, which caters to the dynamism of these product features. This requires re-engineering of the customer lifecycle journey, such as underwriting process. In all likelihood, the sale of microinsurance contracts would be over the counter. You would not be able to do a medical assessment. Policy document issuance. Insurance companies can no longer issue a 20-page document which has really difficult technical legal jargon. It has to be really simple and easy to understand, and probably just be a small piece of paper. So customer onboarding, maintaining engagement points for future servicing, claim assessment. So simplifying these processes doesn't mean that we are diluting the offering, especially for the segment, which perhaps requires better consumer protection mechanisms, but building an ecosystem that can better serve and control product outcomes. In terms of risk controls and mitigations, I think an external control would be being allowed to gain support from reinsurers to cover the segment. And in terms of other internal controls that could be built into the product is having group or household level coverages instead of having individual coverages, making this a compulsory product instead of making it voluntary. But obviously letting consumer education also go hand in hand with that. In terms of premium setting, it's probably rather naive of me to say that it shouldn't be set too high or too low, but I think that is really important, and it's going to impact the uptake for the products. Benchmarking it with government schemes, embedding incentive and nudge features in the product, like establishing loyalty benefits, giving enhanced coverages for certain periods, offering bundled products. All this can only help to make a product look more attractive and actually be more attractive and have a better customer value proposition. And ultimately, the pricing for this segment, it comes down to economies of scale. It requires a certain level of scale to be able to, capture all the expenses that are required in this process. And so establishing partnerships with institutions that have ready access to a large captive customer base would go a long way. So I'll just move to the next slide. So I'm not going to spend too much time on this because I think I've covered off majority of these points, but this was just to compare what conventional insurance and a micro insurance contract would look like. I think I'll just touch upon the distribution channel, which Deepti's already covered off quite well, actually. But I think just one point for me to make is that in microinsurance products, the distribution compensation support is minimized because of the ticket size. So even though it may be 10% or 15% of premium, and the premium is 500 rupees, it is a very small sum. But and especially when in comparison to mass affluent segments that an insurer has been focusing on. But when the revenue stream is compared within the gamut of financial solutions which are made available to the low-income households, like credit and savings, microinsurance product incentives are still quite significant and attractive. There's maybe the same distributor may not see value in being present in both the segments. Like probably an agent might not want to sell to a mass affluent as well as in the microinsurance segment. So alternate distributors would probably be more key to this process. So I'll quickly go to the next slide. So I think very quickly, I'm actually spending, just taking on 2 slides from, there's a recent study done, which was Microinsurance Network, their 2020 Landscape study. This covers, it has rich data. It covers 28 countries, and it has data from 6 to 10% of the low and middle income population, with about 1 billion of collected premium. So these are 2 graphs which basically show, the product categories which are popular amongst the microinsurance segment. Now, it can clearly be seen that life and credit life products continue to dominate the market. But crop and livestock insurance have grown dramatically too in some countries. And it has been noticed that that's majorly so where there is government support and subsidies available. On the next slide, so very quickly, I think the slide on the left, so it represents the varied distribution channels that are selling microinsurance. And what you can see is a large chunk is being sold by agents and brokers. So the high use of agents in over half the products, it stresses on the continued need that the segment of customers feel for human contact. But increasingly, insurers are attempting digital approaches. And in fact, they were moving to digital, insurance companies were moving to digital approaches, but I think now they're going back to a hybrid model where probably the sales acquisition could be, through a call center, but the attribution is happening in a human way. But at least the use of technology is growing throughout the insurance industry, which is great. And especially in countries which have mobile phone penetration and ownerships and mobile internet coverages, which really helps insurance companies. On the right are the claim ratios. Now, the claim ratios, they remain range bound, but I think for catastrophic products, they vary widely. But I think majority of the utilization of a microinsurance premium is going towards expenses and commissions. And it's leaving very little for claims. So I think slowly customer awareness and customer-friendly claim processes are going to be very vital for establishing trust in the providers. So in the next slide. So I'm just going to quickly cover off some innovations which are already present in the segment in terms of product design and delivery. So there are a few countries which starting to innovate on comprehensive health reimbursement products and even pension solutions. Crop and livestock have started to see supply side offering, and that's mainly with government subsidies, and it's also with simplified claim structures where they're able to introduce index insurance. And so it doesn't require claim assessment to happen, at each individual level. MESO coverage, so community level coverages are being considered. There has been a surge of mobile money and transactions through money transfer agents, though MNO businesses are starting to see a slowdown. But obviously transaction on the mobile network are going quite strong. I think digital platforms like e-commerce and ride hailing, they're being seen as the new distributors, but I guess they're not necessarily they're not targeting the low income segments. But what's interesting to note is that most of the product uptake on these platforms are actually the compulsory kind of products and not so much voluntary. Then hybrid distribution is also emerging, which are part assisted and part and rest is digital acquisition. In terms of bundled offering, a combination of products being sourced as well as non-financial service bundling is becoming commonplace, where you can be offering wellness and business support and market access services, which helps to close the risk prevention loop as well for the underlying segment. I think all of this, what it underpins is the importance of laying the foundation for products which are also focusing on customer awareness campaigns, and they enhance digital literacy because digital adoption is actually becoming quite important, and one can really say that now in the aftermath of COVID. So just moving to the next slide. So I think just very quickly, any conversation would be incomplete without a reference to COVID and its impact. I think it very simply put by me, it would be, I think the impact has been on continuity and digital readiness. So for insurers, for new business as well as renewals have been impacted. Insurers have had to overnight transform the delivery approach to a non-face-to-face format. And there are likely to be second-order impacts on claims, and this may increase, the cost for consumers because it will get passed on to the consumers in terms of high premiums. However, I think the bright side has been that the pandemic has forced insurance companies to re-engineer the existing processes and controls and accelerate the digitalization journey. And companies are already starting to see saves, last year and this year, and probably in the future from this. The only flip side of this also is going to be that conventional insurers would want to go and focus back on a secure and stable revenue stream that they might avoid entering into innovative segments and innovative solutions and probably stick to traditional lines of business. For consumers, and I'm implying low-income households, there has been an increased awareness of risks, and a clear need has been established for comprehensive solutions that completely cover the exposures. I think it's becoming necessary to overcome the reliance on assisted models and getting comfortable with a non-face-to-face model. It's becoming imperative for one to be digitally educated. And it's a steep learning curve for some, and it is in a way creating a digital divide. I think in very end, I'm just leaving with one last slide. So I think this is just the last note that I would like to leave with, and this is part of the ILO Social Finance Fellowship Program. I think the concept is integrated risk management, and this is what I think Deepti was also mentioning before this. So insurance is particularly relevant, especially when we're talking about large losses and we are talking about uncertainty of cash flows and where there is informal support of friends and families not available anymore. But there are significant limitations to insurance as a solution. There has been considerable progress on the supply side, but there is still an insufficient number of insurers who are present in the low-income space. And there are also demand-side issues. Clients have limited understanding of insurance. They don't completely trust insurers. Insurance itself is also an inflexible tool. If one has life insurance, it does not help if the house burns down or if you fall ill. So in order to be more effective, insurance has to be a part of a broader menu of financial services, which includes savings, credit, money transfers, and even government social protection schemes. And only that can perhaps collectively enable the working poor to manage to diversify risk. So for low-income households, the government-sponsored social schemes could be cost-effective baseline protection mechanism, and financial service providers could augment these solutions further for an increased and complete coverage against risk exposures. So that's it from me. Thank you. Thank you so much.
Thanks, Prashansa. So I have a couple of questions. I suppose you might already be able to see them, but nevertheless, let me just read them out to you because I think these are super important to ask. One is from Rajalakshmi. Her question is, the main challenge with low-income groups is the lack of documents like ration card or address proof, which excludes the poorest of the poor. Has there been any innovations to deal with this? And really your experiences across Myanmar and the other countries would actually be super useful. Because India has gone on in its own direction, but really would love to know it. And so, and then there are a couple more questions. So, would you prefer that I just read them out, or shall we just kind of just mention those and then?
No, I'll take on this first. I think this question. I think that's what I was mentioning about alternate data sources. In fact, one is even the kind of the quality of proofs one gets, you would not be able to validate it. So I think that's also the other challenge. So I think that's what I was talking about, alternate data sources, using proxy sources, like how do digital lenders operate in this space? They are also, asking, getting handset details or getting SMS logs. And there are a lot of insurance companies, especially in the insurtech space, who are not even asking for, like a CIBIL score, who are not even asking for this information. They're just getting access by just having just getting you to upload utility bills and things. So, and I'm sure insurance can probably start to innovate in that direction as well.
Okay. So that goes beyond, that still doesn't solve the KYC problem, right? Like it's...
Yeah.
Okay. There's a question from Clement. So despite being a pushed sale, in most cases, microinsurance has low offtake and credit life sells because it is funded. So do you think funding options for all insurance products will improve take-up?
So that's a really interesting question. So I agree. I think credit life is sold because it's become like a financing scheme, and the lenders are more interested in it than the consumers at the end of the day, because obviously they don't get much. But I really think that so I've seen in markets like Philippines, I don't know if it's an enabling regulatory environment, but again, there are enough solutions available in the microinsurance segment which do not cost so much. I mean, you do find solutions for like 100 rupees which have life insurance coverage, have hospital cash, have accidental death benefit, and there is a take up. There is a voluntary take up for these products, and probably more so because they're sold not so much at an individual level, but they are sold on a group and a household coverage or a community coverage level. So I guess those are the things that help. Individual take up is difficult for insurance companies to drive. It's not their forte. I think that's where tying up with the right distribution channels would help more.
Okay, great. Couple more questions actually. Hansi asks, do you know if someone has looked at bundling insurance with the government retirement initiatives such as NPS?
I actually don't, but I know this of Philippines. I know that that's exactly what we were trying to do. In Philippines, they actually have 3 government services. It's called SSS, which offers life insurance. There is PhilHealth, which is health insurance, and the third one is Pag-ibig, which is towards saving. So we were keeping that as the minimum contribution level and augmenting these solutions by offering. So let's say adding health insurance to it. So let's say about 5,000 rupees is covered health insurance under the government scheme. So we were adding another layer of private health insurance, which can cover off more than that. So, but I guess I'm sure Deepti can answer this better than me.
So so I think my sense is, Hansi, to your question, nothing prevents a provider who has permissions to sell both insurance and NPS from bundling both, right? You could do that, and I suppose Nikhil, who is on our panel next, might be able to add more flavor to this. Whether anybody has done it, that's a great question. Again, I'm not sure of any specific instances where this has been, and there are various reasons for it, right? It's not just about intent. I think there are other hurdles to be crossed, particularly, for example, the NPS Swavalamban product, which got stopped in between, had a lot of negative repercussion for lenders who were involved in selling that product. And so you don't want a kind of external regulatory shock like that to impact your other business lines, right? And you don't want people to stop taking insurance because something like this happened on the pension side of things. So it's still very, very difficult to do bundling. And I think a lot of the questions here don't have easy answers. And while there is interest, and I think this is a question that I'm going to post to Nikhil anyway, but as there are, I think there is a lot of interest from the households, and he will share more details. To have bundled products where there are multiple things, but they're happening in like small ticket sizes, and people know that, okay, this is what I'm paying for over multiple periods of time. I'm not sure if you could imagine bundling a 1-year insurance product to a 1-year, let's say, contribution that you're making to a long-term pension product. I mean, it's still possible, but then that pitch has to be gotten right. Otherwise, you end up, I think, just misleading the consumer into something that they weren't aware that they were getting into. So I think those are the kinds of, because if you say insurance has lapsed, but then the pension product still continues, how do you do bundling really well that you're able to mitigate any of these kind of both confusions, as well as I think it has implications for how consumers will behave with these products, right? So I think those are the things that we'll have to kind of keep in mind. So I think there's another question from Misha, which I think ties well with a question I had on how have these other markets that you have kind of worked in done the small ticket repeat transactions, right? Like how have they gone? And we're talking of premium payments here. So Misha's question is really on, is there any particular reason why MNOs as distributors is slowing down? Especially for countries such as Bangladesh, Kenya, etc., one would imagine that the role of MNOs could be crucial. And in the insurance premium collection space, and I mean, correct me if I'm wrong, do we have a good, other than being able to just deduct premium, what else is the nature of engagement? And ultimately, that's the question, like what's been the role of MNOs? And are there great examples or even learnings on the abilities to do repeated small ticket transactions in a digital
Yeah. So okay. So I think so. I'll just correct a bit more on the MNO. So I think what is not doing so well on MNOs is them pitching insurance products as freemium offering and then adding voluntary products to it, and then and expecting consumers to partake in that, which also increases in turn the telecom providers revenue. So for them as insurance providers is not working, but transactions on the platform are definitely helping. And I think that's how a lot of the transactions, a lot of the micro insurance contracts which are being sold by money transfer agents. So in fact, in the Philippines, what you find is there aren't so many bank branches available, but more pawn shops and more remittance providers and money transfer agents who are available and who have more access points in the Philippines, uh, and they're able to do regular transactions because it becomes because an individual is consumers are found to use them as touch points for making utility bill payments, for collecting remittances from their relatives, and that's where a lot of premium transactions are taking place. So yeah, but I think MNOs are more moving towards having the transaction taking place on the mobile, but not so much selling it themselves, because I think that value proposition is being lost, because half the time the consumers wouldn't even know that they have an insurance contract on the phones.
Yeah. Okay, we have another few questions. One is, why do insurance companies not see the value in spreading risk over a large client base, such as low-income clients? Does it not make economic sense?
It absolutely does. In fact, that's the sense that it makes. In fact, entering a segment like this and then offering a contract on the individual basis is actually a lot tougher for an insurance company. It's actually a lot cheaper when you're able to spread the risk and cover off a community together, or cover off a group which is probably not innate for insurable reasons, but innate for some other reasons. So like to talk about an employer-employee group, or talk about a self-help group, or microfinance institutions, if I'm covering the employees of these microfinance institutions, I know they're not together to buy this insurance product, so they're not anti-selecting against the product that has been created. So it's a lot easier, cheaper, better claim experience expected when it is being offered to groups. In fact, insurance for SMEs, I think Pranav is here too. I think he's a big proponent of that. I think that's what everyone's talking about now, is a better solution for insurance companies to offer.
Okay, that was great. I still have a lot more questions, but I think we've run out of a bit of time. So maybe I think I just want to say thank you, Prashansa, for doing this in the nick of time. And I think we will certainly have more events. So hopefully we'll get to have more contributions from you into the future.
Thank you.
Thanks so much. So may I now request Indradeep, our executive director, to take over, and we can go to the panel.
Yeah, thank you, Deepti, and thank you, Prashansa. So we are now we now have about an hour for a panel discussion, and we have three distinguished guests who will be our panelists. So the way I will do this is that I will introduce each of them just before they speak. I have 2 rounds of questions for our panelists, and then and those are likely to take up about 50 minutes or so of conversation, and then I will open up the floor to questions from our audience in the last 5 to 10 minutes. So let me introduce our first panelist today, and like I said, I will introduce the other 2 panelists when they speak. So our first panelist today is Mr. Kapil Mehta. Kapil is the co-founder of Secure Now, an award-winning insurance broking firm. Secure Now uses technology-based distribution to sell commercial insurance to MSMEs. Kapil writes regularly in the media, specifically on matters that impact policyholders. He is a director of the Insurance Broking Association. He is also the policyholder representative on the Policyholder Protection Board subcommittee of 2 insurers, and on the SME advisory board of a leading general insurer. Kapil was formerly the managing director of DLF Pramerica Life Insurance Company Limited, nominated by Prudential Financial Inc. Prior to joining DPLI, Kapil has worked at Max New York Life, McKinsey and Company, and Unilever. He's a member of FICCI's Health Insurance Committee. He has studied at IIM Ahmedabad and IIT Delhi. So, Kapil, I will first come to you with a set of questions, and these questions have to do with some of the themes that that have been touched on by both Deepti as well as Prashansa. Our discussion is meant to focus specifically on two issues. One is the issue of suitability, and the other is the issue of product lifecycle servicing. We have heard from Prashansa that lifecycle servicing is key for low-income households. But we have also heard from her that scale is important. So I would like to ask you to reflect a little bit on this question of scaling suitability. You know, what does it mean to, first of all, do suitability? What does it mean to scale suitability? And then how to do product lifecycle servicing and how to scale that, because we need both of these things. We need suitability and product lifecycle servicing, but it would appear that we need these things at scale if we are to meaningfully service low-income households. So Kapil, if you could reflect on these two questions, and also tell us what the experience of Secure Now has been in these areas, and what kinds of regulatory barriers companies like Secure Now are facing in order to be able to deliver on these two objectives.
Indradeep, thank you very much. It's a little awkward to listen to an introduction of yourself, but I'm glad you've got that out of the way. I'll just speak for a few minutes, on both these issues. And let me just take them in the order that you mentioned. The first is on suitability. What I feel, there's absolutely no doubt, as Prashansa and others have pointed out, that it's Deepti pointed out, it's a critical aspect, particularly when the person buying the insurance is not an informed buyer. It's different when a large company is buying insurance, and it's different when an individual is buying insurance, and it's different when somebody from a certain segment is buying insurance. But what I feel is happening is that there is a tendency to push the responsibility of suitability into a method of disclosures and taking sign-offs from the ultimate people who are buying the insurance. And I don't believe that that is the best way. So, just putting out all the information on a piece of paper or on a mobile phone message and taking a sign-off is not good enough, because people are not able to comprehend what is happening. And in the earlier session, there was a question on why is NPS not bundled with insurance, or has anybody done it? My concern always is that, the more one can unbundle, the easier it is for people to understand exactly what they're buying. And bundling always leads to problems. Even in life insurance, for example, when you bundle protection and savings and investment, it becomes more and more complicated. So on suitability, what I do believe is that it's important to, as insurers and as the ecosystem and the industry, we have to take some decisions on what is right from a suitability standpoint. So I think a framework where we say things like, we will be 5 times more cautious when selling a market-linked product to somebody from a low-income group is one example of, or we will not sell a life insurance which has a 10-year premium payment cycle to somebody who is 85 years old, because obviously there may not be a proper understanding of what is being bought. Or if you're selling a pension product to somebody who has just started working out, that may be a genuine need. We're going to ask 3-4 more questions before we make sure of that one. So I think the industry, all of us have to do our thinking in terms of what's important, and expecting customers to sort of sign off is maybe a bit much. So that's sort of item number 1. Item number 2, the point you asked is around the whole product life cycle. And I think that's got 2-3 aspects to it. One is you place an insurance. You collect premium over time, and then over the course of the insurance, there are claims that may come in. All these sort of go into the product life cycle. In many cases, I think the answer to this lies in the product design itself, which we have not yet fully explored. So, the regulations constrict us to give 1-year products. In some cases, we can give 3-year products. But, maybe there's a case to have much longer term products that we have. I think the payment method is a little easier to solve because the way payment mechanisms are evolving today, it's possible to sort of do automated payments and sort of collect money. It's a little easier, although it's not fully solved yet. The claims issue also, I believe, is something which can be solved through product design, because the way most claims are done today, at least on the non-life and the non-health side, it requires an evidence of damage. If you have a property which is destroyed, you got to have a surveyor or somebody come and say, look, this is the damage that has happened. And there are product solutions available which get out of that, which will say something as simple as, if it has rained more than 15 inches, we're just going to pay this money out. If the crop was delayed by this much time, we are going to pay this money out. If the yield is less, we're going to pay the money out. And I think we need to explore those parametric insurances a lot more. Many of these are not pushed fully because the ecosystem has not pushed this too much, but and in some cases, a regulatory restraint that we have. But these are big opportunities. You asked about. I'll just take a minute or two because I'm sure there are other panelists here. You asked about Secure Now. Our focus has been on selling commercial insurances to small businesses. And these are, we have about 20,000 clients. 90% of these are less than 100 people, and 50% of these are less than 10 people. So these are shops, small establishments, and so on. Even here, we find that although this is a little different segment from the conversation we've had so far, even here we find that we have some major challenges around, of course, the product life cycle, but also around the way incentives are structured. Because in India, the word commission is a dirty word, and you sort of have to be mindful of what you say when you say commission, and you got to sort of sidestep that. But the fact is that unless it's economically viable for us to get into a small segment, we're not going to do it. And I think this point was made earlier as well. So if I'm selling a group personal accident, which is costing 100 rupees, I'm just picking an earlier example, and I earn 10 to 15 rupees on that. And in that, you expect us to sort of get down there, do a suitability assessment, make sure if there's a claim, we fulfill the claim, do a renewal, all of that. Many of those activities are not viable. So it's a bit of a contradiction, because you have a situation where compensation is capped by regulations. But when you look at the economics of insurers on these products, and there was one slide Prashansa showed about losses, the losses are low. And if you take a if you were to look at the profitability of many insurers on these, on the products we're talking about for lower income groups, you'll find that they're highly profitable products, even after I build in the claims and the management costs and the compensation and so on. So I think there is a need to not control every aspect of that pricing, to let some of these pricing go free. But at the same time, if you have a situation where at the end of a year or at the end of 2 years, there is excessive profit made in some of these products, then there should be a mechanism for returning money back to the persons who spent it. So I'll stop here because, I'm sure there are many other questions, and I'll come back later in the week.
Well, thank you, Kapil. Good points. And in particular, pricing is I think a deep problem, tough problem to solve in this domain. Our next speaker is Mr. Shrikant Kumar. Shrikant is the CEO of the Vimoseva, and he has more than 13 years of experience, both corporate and of development sector institutions. Vimoseva is the insurance cooperative of Seva and extends services to around 1 lakh low-income households in 5 states of India. Shrikant is also a committee member of the Combi Product Committee that was constituted by the IRDAI. He has implemented different multi-stakeholder projects in the areas of microfinance, microinsurance, livelihood, health, childcare, and capacity building in India and other countries, especially in East Africa. He completed his management study with specialization in rural marketing, microfinance, and social entrepreneurship from the Indian Institute of Forest Management in Bhopal. Shrikant, welcome to the panel.
Thanks.
Has
Thanks,
Shrikant
Andre.
dropped off? Yes, Shrikant, hi, welcome to the panel. I would ask you to speak to the same questions that I posed to Kapil. First, please describe to the audience what Vimoseva does and how these questions of suitability and lifecycle servicing manifest in business, how you all handle these issues, and what you would like to see, since you are also part of the Combi product committee, what regulatory changes you would like to see happen in order for the objective suitability lifecycle servicing to be met. And
Thanks.
Shrikant, you have about 7 to 10 minutes, so don't worry about that.
Okay. Thanks, Indradeep. And first of all, very good presentation by Dipti and Prashansa, and it has set the tone for today's discussion. I will refer 2 points from their presentation and then I will come to our work. They talked about the household approach and they talked about the integrated. In fact, Dipti talked more about integrating at different level. I'm talking even integrated risk management. So, as you mentioned, Vimoseva is the insurance cooperative of Seva, and we work with informal sector workers. And truly, our market segment intersect where we talk about the different types of government schemes which they should avail, and certainly to address the need which is still missing in their basket by providing different sets of products. Then when it comes about the regulatory aspect of managing and operationalizing our work, we started much before even the regulator come up with the idea of micro insurance. So you can imagine how our work evolved over a period of time in very organic way. So when Vimoseva started, everything come up with the demand from the customer. So we have not done any research. We have not done any market and product designing aspects. We just ask our members what you need and we try to find solution. And we come up with some good solution over the period of time. Unfortunately, now in those days, regulators were not very keen to understand, or even the insurance companies were not keen to understand those solutions. But now market potential are forcing them, everyone, whether it's insurance companies or regulator, to bring some suitable regulatory aspects to manage this segment. So I will start first from this life cycle, this product aspect. See, in our Seva, we call it a very lovely terms as a bundled product. Because when we started, we just started from the this credit line, because Seva Bank was lending and there was some risk to those lenders, and we are not getting our money back. Then we started from there. But then over the period of time, and now research are also showing that some of the risks like health, it's very imminent and very, they can perceive, they can see it day in, day out, that how major portion of their income is going into this health expenses. Then talking about the entire family, because you know Seva members as being as a human, they think about family. They don't just think as a themselves or their risk and like that. So then next comes covering about entire family. Then this concept of that, because their work is their home, and you can say vice versa also. So this asset aspects come from there, because apart from their labor and a small assets, what they built over a period of time, they don't have much asset. So even protecting those assets against different natural perils and fire and everything was very important. So we come up with some their demand driven product, and then we built, frankly speaking, on common group platform. And there is a very good reason for that. Nowadays, pricing and adverse selection and moral hazards has its own story, but we always feel that the common risk brings people together, and you have to address those risks at community level. Then only you can find some good solution, because we know whatsoever be the product design at unit level, this is going to be very small ticket size. Digital and everything can address up to a level, but you have to find a solution at community level, and not just the product and viability. At community approach gives you different other aspects also, which is very indirectly effective, like in claim servicing. Nowadays, India has in last 5 years all sorts of ecosystem, like identifying the right person, identifying the right assets, identifying the right age, and all sorts of things. You can just imagine 15 years back or even 10 years back, in a slum of Ahmedabad, you can't find that who is the owner of that hut, or the in a local language you call Charlie. So you can't identify, you can't assess the age of that member correctly. All sorts of this problem gets sorted out at community level, because there are ways of triangulating and confirming these informations. Then we bring the community in itself in even the servicing, because we know that to reach to the last mile, you need someone who community trust. And people like Indradeep and me can't go in a community and transact with them, and they will trust, because insurance in any ways, it's a very difficult concept, and whatsoever you invest in education, it's going to take its own time. Even the middle class of India and even educated people are struggling with insurance things. Then the third, which is already very said, but we have to understand that integrated risk needs integrated solution. And it doesn't mean the patchy work, like you bring some portion of the term life, you bring some portion of health, you bring some portion of like that in one product, and then you offer it to it. And I can't comment the recommendation we are proposing in this product, because it's still report is yet to out. I will certainly say that we are trying, and certainly we feel that we need to see it in a comprehensive way, so that customers feel that my risks are covered. It's not like that I have to recall that in this product X risk is covered, in another product another risk is covered. Then I would come to the incentive aspect, which you asked, and certainly this digital and hybrid model, in our case also we realized, and in fact COVID has compelled every one of us to adopt the digital aspect. But still in India today's itself, there are some reports gap between digital access between male and female. So you can imagine, I'm not talking about even about the financial aspect, the well-to-do families and lower income household. Even the normal households have a lot of digital divide between male and female. So India still has a lot to go on those front, but it's good start, and solution lies somewhere in hybrid things. So incentive needs to be linked with all these realities on the ground, because it's not just selling the things. It's like, I would say, bringing a family into your fold, and it brings your trust into the institution, trust into the concept, and trust when to realize that when claims will come, ultimately I will get paid. And in one of the slides, Prasansa mentioned that 29%, I mean, it's like, sorry, outrageous. If you have so much, so less of the claim ratio, how people will get benefit? And I keep saying that for low household income, getting claim is the real truth. Apart from that, you can't explain them insurance that you will get something which in the future, which you have to pay right now. So certainly all these incentives needs to design. So I generally recommend, and that first of all, that insurance companies and regulator has to understand that to address the low household, in low income households solution, you have to bring their expertise, their trust, and their knowledge into use. And when I say this, it's not just limited to the sale or just bringing some business. You have to give them opportunity to serve also, bring some claim servicing, bringing some documentation support, because I mean hospitals are not giving proper document, because sometimes poor has multi-layer, frankly speaking, barriers, not just the money barrier, it's a confidence barrier also. So even there also you have to do some hand holding. But who will pay for that? So you have design, because IRDA says that insurance companies cannot outsource all these, because for them it's a core business. I don't know how much technical it is. We can train, and in Remote Seva we have proved it, that if you train people perfectly, you have to simplify it, the technical aspects of the claim and all those things, and people can do it. And particularly in our case, our women are much smarter than any other, I would say, because they have life experience. So we are doing that, we are trying that, and we are recommending that. Then only what Kapil also saying, that then only you can bring this incentive aspect. Otherwise, upfront incentive, what we are doing in normal insurance company, where 35% or something, and persistency rate at the end of 5th year is such a low percentage of the, it's not going to work, particularly in the micro insurance sector. And then last but not the least, which we feel that those who are going to serve the customer at last mile needs a good hand holding, and insurance companies in India are certainly not capable for doing that. So we have to find, or we have to design, or you have to give a regulatory support to such institutions, those who are doing it. Certainly in our case, and other institutions, those who are working with the society. Because in micro insurance, unlike normal insurance, a micro insurance agent will get X%, whether he or she is selling 10 policies or 200 policies or 500 policies. So I think all these aspects needs tweaking, redesigning, and some regulatory support also.
Thank you, Shrikant. Our next speaker is Nikhil. Nikhil is the head of liability products at Dwara KGFS. He has over 22 years of experience in sales, channel distribution, and capacity building with varied industries like telecom, consumer durables, life insurance, and microfinance. Prior to joining Dwara KGFS in May 2016, he was heading life insurance operations for Oman Insurance Company in Abu Dhabi, UAE. And since joining the life insurance industry from 2006 onwards, he has worked for HDFC Life, Reliance Life, and Birla Sun Life in different capacities. At Dwara KGFS, he identifies the scope of expanding non-asset products with focus on life and general insurance. He builds wealth management solutions for low-income households and manages the product life cycle with respect to the wealth management solution. And he identifies and onboards partners for life insurance, general insurance, mutual fund, and other savings products which will be part of the wealth management solution. So Nikhil, welcome to the panel. And,
hi Jatin.
Thank you for taking the time. So Nikhil, I will ask you to speak to the same. You have all now heard Kapil and Shrikant also give us their perspective. So if there's something in particular that they have said that you would like to pick up and elaborate on, that would be great. But also it would be great to hear from your own perspective, what is Dwara KGFS doing for suitability? There is this idea of wealth management, which not all of our audience may be familiar with. So if you could please explain that a little bit. And also, I noticed in the chat box, Sanjeev had written in saying that that Dwara KGFS and Dwara Smart Gold have very successfully bundled an insurance product with a savings product. So if you could also throw some light on how that product was conceived and how that product is doing, that would be great. Thanks.
Yeah. So Indradeep, anyway, first of all, I'm so happy to be in this part of this discussion. And the two things which I've been keenly watching is from Prashamsa's presentation onwards, or on what Deepti spoke. It's like the focus is clearly on low-income households, and that too, insurance for the low-income households. That is what every person is looking at, and every other company want to crack also. Like every insurance company want to move from urban area to semi-urban or to the rural masses. So, but still there are a lot of roadblocks which are seen mainly in terms of the products as well as the servicing of those households. So if I pick the first one, that is the suitability of the product, and then link it with whatever Dwara is doing. So if you look at the low income potential policy holders, there are actually a few points, few things. I mean, this may be similar to what Shrikant or Kapil or even Shamsa spoke about. So the needs and demands of the low income household is entirely different. And identifying the exact want of insurance for this low income household really matters a lot, because that insurance culture is not yet developed there, and there's a lot of work that has to go in terms of building that insurance culture in the low income household. Yes, the poor cannot afford comprehensive coverage. That everyone knows it. But which benefits are they most willing to pay for? Because the payment of the premium, I mean, it's really the most important factor for the low income household. So which are the benefits that they're most willing to pay for, and how much they are willing to pay for? Matters a lot in identifying the products for the low income household as such. So suitability of the product, easy to say, okay, this segment needs this, but are we looking from their angle? I mean, by wearing their shoes, what is they looking at? So if you ask me about Dwara KGFS, yes, as everyone is aware of, Dwara KGFS involves only in rural households, low income households, offering credit products, which is a core business. But in the last 1 year, and we were in the last 10-12 years, we were offering different insurance products also. And now we understand that the wealth management solutions, that is what is more required for the low income household, because wealth management, it's not just savings, it involves insurance also, because insure and savings, both are important for the wealth management solutions. So in the wealth management solutions which we are offering, we offer a small scale, as you were saying, savings product like gold investments, and to mitigate the risk, we attach the insurance parts, products also, which clearly it is towards the lower income households. So whichever product we look at for the wealth management solution, or whichever the insurer we look at, we clearly keep this in mind, that this is for the low income household. He should understand the product, he should understand the exact benefit of the product, and it is not just for the individual or the customer, it is for the entire household as such. So the wealth management solution as such is built around the most important thing what the Dwara KGFS exists, that is the customer's information. Yes, for the outside world, it is like collecting customers' information, but for us, for Dwara, it is collecting the information of the household, and we call it as FWR, that is a financial well-being report of the particular household itself. So financial well-being report gives us a lot of information about the customer, the earning members of the customer, what is the small assets what the customer is having, how many family members, XYZ, everything about most of the things about the customer's household. This and it's not just manual work which is going in there. I mean, the information was being collected, go into an AI, and the output of the AI throws what is the savings which can help this customer over a period of maybe a 2-year period. What is the insurance products which should go along with the wealth management solutions. So this wealth management solution, the insurance product which is there in the wealth management product solution, clearly take care of the short-term risk which is there in the which is expected in the next 2 years. Because I'm talking about 2 years back, because wealth management solution what we have launched in the last 1 year, it's for a 2-year term. So this is taken care to a larger extent. Now you regarding the product lifecycle servicing, yes, how does the solutions take care of it? Yes, this financial well-being report of the customer is updated on a regular basis. So that's the most important thing. So the information of the household is collected on a regular basis, at least once in 6 months. So updation happens there, and based on that, again, over the period of 2 years, we are able to provide extra solutions or the additional solutions for the household, which is going to help the household in different manner. So the products which we normally give in this as a part of the risk mitigation is small scale products, small premium products like the personal accident insurance or a hospi cash product which take care of the hospital expenses of the household assets. Then if the customer is willing to, slightly above the lowest strata, then maybe he has got a bigger goal. We want to cover his goal. As such, we offer a group term life insurance product, which gives a better coverage for the customer. So as such, it is like we at Dwara sees the particular customer and the entire household as such, and offer the respective or whatever solutions what the household requires. Now, the second thing what you were asking is, it's like in terms of how good this services can reach the customer. Now the product is like this. Now, who's going to take this product to the customer? Yes, Srikanth was saying, yes, if people from the community is there, from the particular low-income household community is there to converse with the low-income household, the communication will be very easy. So this particular sales force has to be entirely different from the normal insurance sales force what we see in the urban. So if the people are from that community, definitely not just the communication, the way in which they see the insurance products also, that will vary. The sales force itself, they themselves will see the insurance solution as a different product for the similar sort of people around them. Then coming quickly into the incentive part. Yes, as you all know, it's like for any other than micro insurance product, the loading and the first month is first year is so huge. The incentives on the first year is so huge. Then it tapers down. So here I think this community of so-called, maybe as Srikanth was also saying, this informal lot of sales force, which we can call initially, can be turned into a formal sort of sales force with proper training, with proper inputs, and they should be looking for a long-term association, not just with the intermediary or the insurer, even with the customer. So they want to give, want to see that household as one of theirs and want to get associated with a particular household and give a long-term solution. So the income also, or the rather, we can use about the same incentive or commissions. The commission also they would like to get throughout the entire life cycle of their respective product. So the proper selling can happen, or proper communication on the product or the policy can happen, and it will not be like selling a product. It will be almost buying a product from the customer side. Insurance, as Kapil was also saying, or Prashanta was also saying, it's like a selling which is happening. Now, can we move from the selling proposition to a buying proposition at the low-income household? Because there, I think mostly it is a connect which happens. Connect, and it is not going to be the connect between the insurer, the primary insurer, and the customer or the household. It's going to be the connect between the intermediary and the customer or the household, because there the low-income household might not be looking into what is the name of the insurer, or what is the actual how well placed this insurer is in the insurance community as such. But he will be looking at the intermediary who is going to tell him about the benefits of the product, how it's going to help. So I think before going into the incentive part, the intermediary is the most important critical factor there, and then the incentive which will help both the intermediary and serving the household. I would like not to stop at the policy level of the particular policy or the solution which the intermediary have sold or rather bought by the customer. It can even lead to the servicing of even the next generation as such at the household. So not to stop there at one particular policy servicing, it can be servicing of the particular household for generations. That can happen. I think I would like this particular point. Take this particular point from Life Insurance Corporation of India. where we have the agents and servicing a particular household, even in an urban household, for generations. So that is I mean, primary thing which can apply for the low income household. So these are the important things what we have seen, which is helping, which is helping Dwara to a certain extent. Yes, we have also learned a few aspects, because by selling this long-term insurance product or rather the endowment sort of plans for the low-income household, we realize what is a mistake. I mean, in terms of like customers are not able, the low-income households are not able to see a horizon of 5 to 10 years. They are able to see only a small horizon, either in terms of premium payment or in terms of a policy as such. So need to identify those products which is going to has to be bought by the low income household, both in terms of premium payment and the benefits of the policy. That is, I mean, there both the insurer as well as a regulator has got a huge thing to play there, because it's not just even the insurer. If the insurer has got a bigger heart to offer such a product, definitely there is a cost involved for the insurer, which is going to hold him back. Now, where is that the regulator can come in and offer his helping hand so that the insurer will be able to provide that suitable product, which is going to serve the low income household. There, the regulator can play a large role there, supporting the insurer a lot. And from the insurer, identifying the right intermediary who can sell or give the solution to the household, low income household, and that too not for one generation, maybe for the entire generation. And for Dwara, a company like Dwara KGFS, which is the core business is credit, we don't want to have an impact. I mean, have this insurance product creating an impact on the core business as such. So, I mean, in terms of like the EMI payment, everything getting loan EMI payment, everything getting into trouble because the customer is not served properly through the insurance product. So both has to go hand in hand. So, I mean, we are taking extra caution in selling insurance product to the customer or offering the solution to the customer in terms of let the customer understand clearly what exactly, or maybe I'll use one more term there. I mean, like, why can't a need-based selling approach for the lowest income household? Yes, Dwara is following that with the FWR and all, but why can't that be taken it along across to every household, where we understand the exact need of the customer of the household, and then offer the proper solution to the household. I just pause here. Maybe a lot of things are there which I think Kapil, Srikanth have touched upon, and maybe a lot of things we can speak about in the next few minutes.
Yeah, thank you, Nikhil. No, definitely very interesting comments. And I think Dwara KGFS, because it is a multi-product originator, I think perspectives that you are bringing are particularly helpful to think about suitability. You know, you talked about bundling products. Earlier, Kapil said something, you know, to the effect that unbundling is also quite important. So Kapil, I would like you to reflect a little bit or tell us a little bit more about on that point, because it would seem to me that if you're a multi-product firm, say like Dwara KGFS, then I think the objective of suitability can perhaps best be served through a kind of bundling. Again, to serve not one generation but multiple generations means also that the financial plan that you're really taking on the responsibility of financial planning for the household. That is, I think, the vision behind the financial well-being model that Dwara KGFS follows. So I would really like to hear your thoughts on this bundling issue. And if you could clarify a little bit what you meant earlier when you said that unbundling is important.
Maybe, Indradeep, I will take one example and talk about that. And since a lot of the discussion has been on life insurance, let's just take that example for a second. As everybody knows, you have investment-oriented life insurance and you have pure risk life insurance, which is term insurance. Today, the way and I'll take a compensation lens for a second, and then I'll come to a customer lens in a moment. if you take a compensation lens today, the way both these products get compensated, there's a percentage of the premium that gets compensated to the intermediaries. And the caps for both of them are similar. Now, the question is, this is one of the reasons why over decades and decades and decades, if you look at the amount of term insurance that has got sold in the country, it's extremely low. Because from a distributor standpoint, it does not make sense to sell pure risk term insurance just because you earn so little about it, doesn't cover your costs. Whereas what has got sold is much more investment oriented products. So the moment one starts to think of bundling, I think one has to be mindful of what are the compensation structures you're building in. If you're in a stage where if you're able to compensate higher amounts for pure risk as compared to what you do for investment, then there's a case for making, from a distributor standpoint, almost making it neutral about whether investment gets sold or whether pure risk gets sold. But then you have to have the flexibility to sort of change how the compensation gets bundled into that combination product. So that's the distributor standpoint. From a customer standpoint, the part, now everybody on this panel is far more educated about and knows, works closely with the low income groups. But what I have seen is that even with the middle income groups, and I dare say even with the high income groups whom I see, they do not understand what they are buying. So you take the life, let's talk about the life insurance. There's a part of our business which works with high net worth individuals in metros. And these are really high net worth individuals, exactly opposite of the spectrum that I'm talking about. Every week I will get the insurances they've bought and they'll ask me, for my comments on it. And it's nonsensical what they've bought because they haven't realized what they paid, what returns they're getting, what is the surrender value on the whole thing. So the only question I have is, when such well-educated persons are not able to understand what they're buying, how can you expect somebody at the front line, given I dare say that they're as intelligent, if not more, in many aspects, but still it is too much of a burden on them to understand what is the complicated product they're buying. And then when you bundle it all together, so when you take a life insurance which bundles investment and protection, that itself creates chaos. Now, with due respect to Srikanth, I don't know the workings of the committee and what you'll come out with, but just my humble submission, now you bundle your life insurance with health insurance or some other property insurance and all that. I struggle to think how they will understand what they're buying. You can still do it, provided the manufacturers and are sort of, there's something in the regulations and the manufacturers make sure that the product you're selling is in the best interest of the buyer, so that even if it is missold for some financial reason, it is still a good product to have. That is the case, for example, in term insurance or health insurance. You can't, there's a limit to how badly you can sell a term insurance because it's always needed. So I think those aspects also become important, and I'll sort of stop at that point.
Yeah, thank you, Kapil. Srikanth, if you want to say something.
Yes.
I can see that
Certainly, this is in our notice, and you can imagine how mis-selling can happen if it is allowed to do by the front line or even by the insurance. So this is certainly would have some standard guidelines even for the product design. So I will not reveal more than that. So it has taken care, ample discussion held. So lots of safeguards, because we know if we give freedom on all fronts, unfortunately, few people may misuse it, particularly for this low segment. So there needs to be some standardization, there needs to be some simplification, there needs to be some, or I would say very less exclusion. All those aspects are certainly taken into consideration, and what you are saying is certainly a matter of concern. So committee will look into it, and committee is looking into it. So, but obviously you have to understand that ultimately practitioner also needs to be honest with because you cannot, again I am saying, insurance industry unfortunately in first decade of its operation has done something where they should have not done it, frankly speaking. I'm not generalizing the things, but certainly there are some practices which has harmed in mid to long term. So at least when we go for this low income household, please, I humbly request that see it as a business potential, but certainly more as, or at least equally as a social responsibility also. So we all have to see in that aspect. Then only it will grow. And now Nikhil is talking multi-generational. Even if people are not staying for 5 years with you, so it's certainly something wrong with us or everyone. So we have to design product, we have to commit, respect our commitment, what we are committing to the low income household. And simplification, again, I am saying, just give these 5 things will not be covered, except everything will be covered. Why not we can design products like that? It's as simple as, means even for low income household assets, you have to have mentioning of a nuclear war and all those things, which is certainly impossible to happen. Or even if it will happen, the 50,000 claim of assets, how does make it a sense? And in any way, if portfolio will become large, which is not right now, is going to be reinsured, and there are reinsurance tools and everything. How you can solve all the problems of moral hazards, adverse selection, complexity, everything on front end itself. So we have to design or rethink that something needs to be addressed at front end, something needs to be addressed at different level by technology and everything. And then only we can find the solution. Otherwise, it's very difficult if we go by only one aspect like product design or regulatory. Everyone has its own limitation, and every aspect has its own limitation.
Indradeep, could I just add one very quick point, if it's okay?
Absolutely, yes, please.
I feel one of the very important things in designing these products, we often think of incentives at the time of acquisition and all of those aspects. I think one very important aspect is the point of exit of a customer. So if they, I won't say when, if they realize that they've bought a wrong product and they want to get out of it, what happens then? Now, in the case of many life insurances, particularly the traditional life insurances, the penalties are large. Even in the case of general insurance products, there's something called the short premium scale that works. So if you have been in a policy for 6 months, you'll get nothing back. So it's sort of, there's a penalty which is built in. If that could be addressed in a way that they can exit a policy, if they, whether it's a combined or a single policy, if they realize they've made a mistake and do it at a cost that is not prohibitive or not a cost that generates an exceptional profit for insurers, I think that can also go a long way in this process, because then if you know that people will sell the right way. If they don't, if something goes wrong, there is an exit option available, and you're not locked in for a long time.
Yes, yes. So I think that situations like those are really the other side of suitability, and they are necessary complements to any kind of suitabilities-driven approach to selling. So very good point, Kapil. I'd like to come back to both Nikhil and Shrikant. Both of you all mentioned community, but I think perhaps each of you mentioned community in a slightly different sense. So I'd like to hear, especially from Shrikant, a little more on how community can be leveraged. It would appear that community could be leveraged to the service, in the service of suitability as well. So I would like to hear from Shrikant, what he means specifically when he says community, and how Vimoseva is in fact leveraging the power of community in its business.
Yes. So, Indradeep, again, if we talk about the past experience, I would differentiate between how we used and how it can be used. So I will talk about the both aspects. How it is used is very simple to answer, because as we mentioned that like a trust is something in insurance, because you can't keep educating people for n number of years and then enroll. I keep whenever I go for any insurance education, I say them that don't miseducate, but just education will not help much in insurance. You have to buy that product. Like in other aspects, you get educated and you practice and you get benefited. But insurance, whatsoever education you do, you need to buy it. Before that, without that, there is no benefit of that education. So, and for that transaction, you have to have that trust. And community certainly brings that trust. Then, as I mentioned, it that the product design itself, sometimes what we do, we are so much fascinated by this standardization. I don't know, I mean, for micro insurance, in my understanding, even a 50,000 household is a very good business for a micro insurance institution, I would say, not for these things. So why not we think in those lines that a 50,000 household maybe in one district or two district or maybe a spread. Other aspects come into that, the risk concentration and all those things. But there is answer for those issues also. So we have to think in those lines. You cannot have a product or services which work in, again, I would say in Ahmedabad in one district of Bihar or in Chennai or in another district of Tamil Nadu. So we have to have a much decentralization. The third aspect is community. Again, I would say about the servicing, which has improved over a period of time, because now, again, I would say ecosystem has improved. You have a lot of triangulation can happen from one data source to another data source. Now it's much easier to find right, because in a risk business, if you have lower entry barrier, somewhere you have to check that something wrong is not happening during claim and other aspects. So somewhere you have to balance it out. So there also community plays a very, frankly speaking, vital role. Suppose in nowadays it's very simple that everywhere we are getting death certificate. But I just say examples of just 7-8 years back, we were finding difficulty in getting multiple death certificate in states like Madhya Pradesh and Bihar. Suppose someone has some insurance, life insurance of just 30,000 or 50,000. And he has only one death certificate that may be used for other purposes also, even changing the land rights and like that. And they were very reluctant. And insurance company were adamant that we need that original death certificate. And the civic authorities were not issuing another death certificate. So these are some of the practical aspects. So we come up with some community solution, because for us also we have to assess that this incident has happened. If you go back 20 years back, in those days, even that certificate were not issued. So we were taking the receipt from the cemeterium and other places and confirming those incidences like that. So these are the past. I mean, the institution like Seva is based on the community trust and community resource itself. So you can imagine. Then again, for the reference purpose itself, suppose that you have to build a cadre of the promoters. Either because these are the money transaction, you need to have foolproof system, or some physical transaction is happening, then all these reference. So in any case, you cannot take different sorts of reserves or everything. So these references from community help you a lot. If you talk about the future, again, I would say product design can be done. Like suppose that different institution, I say FPO is also a community. Okay, now a more structured community. Earlier there was no structured community. Now a farmer of maybe certain nearby villages are coming together, and they are forming an institution, and they can ask for one set of risk or one set of these things. Same may go for the small livestock. Same may go for the different natural calamities where issues are still not sorted out. Then in health also, we find that this community of network hospitals, I would say, again, when I mention the community, I would say that also. Because somewhere Pranav was, from ILO was mentioning that you have to bring insurance with other inputs and preventive aspect also. And particularly in health, agriculture, you have to. So a community of service provider also you have to build around the insurance. Then only that's going to be viable, because prevention in this low income segment is also one of the tool to stop the high claim ratios. So certainly, when I mentioned the community in past, we used in this way, and in future it can be used in multiple way because things are emerging day by day.
Thank you, Shrikant. Nikhil, a few words from you on this topic. You also mentioned community as being important for Dwara KGFS to create trust and to create that connect between the intermediary and the provider and the customer.
Yeah, Indradeep. I have to talk on two. I can talk on two aspects. Let us see if you take Dwara KGFS as such. How is this community helping Dwara KGFS? So it's like we got individual branches. The branches operated by branch managers and 2-3 sales force staffs, and there is a branch service executive which is managing the branch. So what we have followed for the last 13 years, it's like the people who are going to manage the branch, be it a branch manager or any other guy there, he's from the particular local area. So that means even though the brand as such is Dwara KGFS, they're all permanent employees of the branch, but we insist that these people are from the same locality as such. That means the community. So there's a lot of say when they are selling the credit products or the savings product, or even till we started wealth management solutions, the standalone risk mitigation products also, or the insurance products also. So they can easily understand what the particular geography required, the population there requires, and how are they looking at every solution what they offer, be it a credit product, what is the purpose they are going for a loan? Why do they require this particular saving solution? Why do they require this insurance? I understand that there are good amount of change between locality to locality or geography to geography, and this particular sales force from the local area, which is managing or manning our branches, are able to be in close touch with the respective customer, the household as such, and provide the respective solution. So this is this. And one more thing I would like to add: the people from the local area, when they do this, the FWR, the financial well-being report, that is collecting different information from the customer. I mean, you cannot have dichotomous questions there, shooting questions at the customer. You need to really converse with the customer properly, understand, at the same wavelength, and then extract the relevant information which is going to help the customer in terms of capturing right data for the FWR. So this has really helped Dwara as such. And if you ask me about the other side, the standalone insurance company, which is going to have intermediaries from the same, again, community as such. Yes, I've seen standalone insurance companies deploying as I've told you before, informal groups converted into formal groups by proper training and all, from maybe an NGO which is there in the rural area, the low income area, and those people are able to literally work along with a particular group, understand the pulse of the market, and provide necessary solutions. And the most important factors in insurance, yes, you will always agree that the persistency of the policy, the continuity of the policy, the person who is going to provide the solution. I'm not saying an agent or an intermediary, person who is going to provide the solution to the household. If he is able to provide that right solution and then service a particular household in a proper manner, then the persistence of the solution, of the policy will definitely be there, no doubt about it. So, there are a lot of, with all these digital initiatives which is coming in, why should it just stop at the urban or a semi-urban level? It can really go to the rural areas. WhatsApp is becoming common. We find that our individual customers are maybe they are not able to have WhatsApp, or fully not equipped with an Android phone, or which can have WhatsApp or Twitter or anything, but at least a household is able to have a WhatsApp number. So why can't all this communication go to the household? And now we were thinking about customer renewing the policy. Customer renewing his policy. Now the policy is taken not by the customer, but the impact is going to be for the entire household as such. So if the renewal message or the information on the renewal is going to the household, I mean, through this community, definitely there is going to be more push, maybe from the household as such, for to the particular customer to pay the renewal premium. And on other side, I was even thinking like, if in a community, now Srikanth was talking about the livestock or area where there's good livestock business which is happening, or any other sort of business, there can also be a separate community as such. And if you have one particular agent or intermediary who's servicing a particular community, why can't that renewal, and he's got policies from that, I mean, and that particular area, and why can't this the intermediary communicate a particular person's or the group's renewal premium for a month to all the other members in the community? It's going to put a peer pressure to pay a renewal premium for the other. So there are a lot of things which is different from the semi-urban or urban area, where you have individuals selling this insurance and servicing the customer, and in the remote rural area where you have certain people from the community picking up the customer, understanding the customer properly, and giving a solution for the entire household, for this generation and for multiple generations. I believe that that can really work out. If you have
very important difference.
Yeah.
And one last point I would like to bring in just in community, because there is one committee just recently submitted its recommendation, and IRDA also brought this report in. Public has recommended about the mutual to bring allow mutuals for the standalone micro insurers. So mutuals are mostly community driven aspect, because one of your attendees also asked this question.
Yes, ask
so
the
it's
question
possible, but certainly it should not be I would say artificial community. It should be a natural community. That is another concern I'm trying to bring it. Otherwise, all same brand users will be a community. That should not happen.
Yes, thank you, Srikanth. Thank you, Nikhil. Thank you, Kapil. Tremendous observations. Srikanth, I will just alert you to a question that Deepthi has asked in the chat box. Because we are running out of time, I will just ask you to read the question. Maybe if you can type out your answer there, then that would be great. I just want to say again, thank you so much for taking out time from your busy schedules to be part of this conversation. I've learned a lot, and I have many more questions. I had a whole list of questions, but some other time. I will now hand it over back to Deepthi, who will make some closing remarks.
Yeah, thank you, Indradeep, and thank you so much to the panelists. So I think certainly for me, I'm not going to attempt summarizing all of the discussions that happened, but maybe just points to 2 to 3 giant leaps for me, right? I think it really pushed imagination for myself and the work that we do, not just for insurance but also other products. One is this whole theme around multi-generational relevance for the provider to the household. And like Srikanth says, if you can't even do a 5-year policy, what are we talking about multi-generation? So really, what if we were to kind of stretch the imagination to say, when we think of financial services provision, if you are doing a long-term product, then it has to make sense multi-generationally, or it has to make sense for that period. And also just for my own work to say, why are we not having that kind of an approach for a regulator or supervisor, or even the industry itself to move there, right? And so what needs to be done? So that's really, I thought, this whole, what I would describe as a temporal aspect of financial services, right? And that's really being much more ambitious about life cycle servicing. We're not just saying life cycle servicing from a claims point of view, but it's much more than that. It's really to say, did you go back to the customer? Is there even what Nikhil described, pressure to pay the renewal premium, right? Like, is that happening? Probably not. And that leads to the second, I think, the whole giant leap for me, which is this whole theme around formalizing the sales force. That if it's, and that it's indeed possible, like Srikanth was saying, that it's indeed possible to train community level workers to start doing, say, claims or and even outsource specific aspects of what would otherwise be considered as core, right? In a way that you could mitigate for risks that insurers are otherwise worried about, and even IRDA and the regulator is worried about. And this, I think, goes against some of our findings, particularly on the BC space, which is again documented in the report, to say that, and it's not contradictory per se, but this theme around capacity limitations for the frontline staff to sell multiple products across these various buckets: insurance, investment, credit. But here we are really talking about getting or outsourcing core functions that go beyond sales, and what more needs to be done, and how to get that right in a low cost manner, if I may say so, by engaging with community workers. And so that's again I think the second kind of giant leap for me. And the third is this whole, I think, very nebulous concept of what is a community, right? And from there on, I thought there was a lot of learning that is available for the sector from BMO-Seva to imagine. So yes, there are, I think, various. So even I'm sure, even for Kapil, I think he has, sub brokers and people who are engaged with specific communities, and distribution therefore is actually a game of like having many of these communities and being able to sell through these various communities. But for the low income household, I thought the message was very kind of important, that we are not talking about underwriting an individual risk or at the unit level, which is really the household, but to imagine risks at the community level. And I think that ties back to Prashansa's theme around value from doing group underwriting rather than doing individual underwriting. And so really goes back to this whole, again, I think the assertion that Prashansa was making, that we can't take conventional insurance contract design and overlay it directly to the low income household context. We'll have to think about various, in fact, all elements differently. And that there are indeed ways to do that. So I suppose, so I suppose those are the points that I think quickly came to mind for me. Clearly, we need different strategies, and we need more providers who are focused on the low-income household. Generally, we know that there are, and cost is again a big aspect. Unfortunately, in our report, we have not been able to document how large the cost is when it comes to a smaller ticket product. But I think different providers, particularly serving low-income households with economies of scope, particularly providers who are already doing other products, and therefore it becomes easier to do a smaller ticket insurance product, either bundled or not bundled, because then it's about an incremental cost. It's not easy, but cost is a big aspect. Technology seems to be one, and I think the FWR report and the kind of the tech backend behind it are ways in which one could reduce the reliability or the dependence on the last mile, officers to get suitability right. And there again, while there are initial upfront costs, I think if we imagine a kind of multi-generational time frame, then now suddenly, okay, all of these things will start to make sense. So a long way to go, and I thought this was a great start from this panel. I suppose we've fairly answered all of the questions that have arisen. But if any of you have more questions or want to engage on any themes that have been covered in the report, or with any of the issues that the panelists have raised, please feel free to email the authors of the report. I think the names are provided there. But otherwise, that's it from me. I just wanted to say thank you a lot to each of the panelists. And I think we had a list of very difficult questions, a lot of it which Indradeep did ask. But otherwise, we will continue to ask these difficult questions and hope to elicit responses. Thank you for the courage to come on this, and then just being there for even considering the low-income household and bringing issues there to the fore. Thank you so much.